Welcome everyone to Unit 3 of the AAA module. I'm Mary, one of your AAA module leaders. This is a short video to give you an overview of what's covered in Unit 3. Unit 3 covers the following key topics: the risk assessment process, obtaining an understanding of the entity and its environment, risks at the financial statement level and assertion level, and significant risks. Let's now summarise each of these topics. In the Unit 1 overview video, we illustrated the main phases of the audit as follows: from pre-engagement activities to planning to testing and then completing the audit. Unit 3 starts the detailed discussion of the audit process by focusing on the identification and assessment of inherent risks at the planning and risk assessment phase of an audit. Remember that risk assessment continues throughout the audit. As audit work is performed, new risks may be identified that the auditor was previously unaware of and therefore need to be addressed. The following diagram illustrates the continuous process of gathering, updating, and analysing information and risk throughout the audit process. Auditors gather information about the entity to identify and assess the risks of material misstatement, which can result from either error or fraud. Obtaining information about the entity is a continuous process. At a minimum, auditors must perform the following risk assessment procedures. Auditors usually start their risk assessment procedures with inquiries of management and others within the entity in order to discover what management considers to be the key risks to the business and how management have responded to those risks. Talking with management can usually help the auditor uncover a lot of information. Auditors typically perform analytical procedures over the entity's most recent financial information, which is available, and compare this to the information from the same period in the previous year. These high-level analytical procedures enable the auditor to identify risky areas or amounts, ratios, or trends that the auditor should investigate further. Observation and inspection help support the other risk assessment procedures by substantiating findings from discussion and analysis, as well as providing additional information about the entity and its environment. The auditor could observe, for example, the entity's compliance with key policies by observing the behaviour of its management and employees. The auditor should also inspect a variety of documents related to the entity, such as accounting policies and records. For clients who were previously audited by the same auditor, it is common for audit firms to already know quite a lot about the entity and may have previously identified risk of material misstatement, which may also be applicable to the current year. Unit 3 will focus on ISA 315 Revised, which is the standard for identifying and assessing the risks of material misstatement. Subsequent units will focus on the response to the risks identified. By understanding the areas of greatest risk, the auditor can plan their audit so that they spend most of their time and effort in focusing on these areas. This is referred to as a risk-based audit approach. The auditor is required to obtain an understanding of the entity, which is internal factors, and its environment, which are external factors. This is summarised in the following diagram. Auditors need to understand the general economic environment, industry-specific factors, and applicable laws and regulations to be able to assess how different factors would impact the entity they are auditing. For example, external factors such as an economic downturn would affect different companies in different ways. Another example would be heavy regulation in certain industries, which are subject to laws and regulations that relate to their operations in general, such as legislation governing occupational health and safety, which may have an economic impact which consequently affects the financial statements. Understanding the nature of the entity enables the auditor to assess which transactions, account balances, and disclosures in the financial statements would have the greatest potential for misstatement. For example, when auditing a bank, the auditor would expect loans to be a material asset account requiring audit attention. The auditor must understand the entity's accounting policies in order to assess whether the accounting policies are appropriate, including the impact of implementing a new accounting standard. The auditor is also required to consider the entity's objectives and strategies and the related business risks that may result in the risk of material misstatement. Business risks are risks that may prevent an entity from achieving its objectives or executing its strategies. For example, an entity which has recently completed an initial public offering, an IPO, and is now listed on the local stock exchange would have additional compliance and disclosure requirements set by the local listing rules. An auditor can gain valuable insight into the risks of an entity by understanding how its management and external stakeholders measure financial performance. For example, an internal performance measure used by a retail business is revenue by store. This may be used as a KPI for store managers. This may provide management with the incentive to perpetrate fraud by manipulating the financial statements to overstate revenue. ISA 315 revised requires the auditor to assess the risks of material misstatement at two levels: the financial statement level and the assertion level. Risks of material misstatement at the financial statement level refer to risks that relate to the financial statements as a whole. These are risks that are not necessarily identified with specific assertions at the account level. These risks may arise from issues such as going concern, non-compliance with laws and regulations, a deficient control environment, fraud, and/or related party transactions, which would affect many assertions across the financial statements, hence why they are known as a financial statement level risk. Addressing these risks will require an overall response from the auditor, for example, assigning more experienced staff. The auditor's response to risk is covered in more detail in later units. In assessing the risk of material misstatement at the assertion level, the auditor identifies the key assertions at risk at the specific account level. For example, whether inventory is overstated. In this instance, the auditor would then respond to the risk by performing specific procedures to address the risk identified. When determining the risks at the assertion level, the auditor will need to identify the specific assertion at risk. Now, this is a key concept which you must understand for auditing purposes, and we'll discuss in more detail next. This table summarises the two categories of assertions, which are classes of transactions and their related disclosures, and account balances and related disclosures. There are 6 classes of transactions assertions. These assertions are applicable when looking at items in the profit and loss statement. There are also 6 account balance assertions, and these assertions are applicable when looking at items in the balance sheet. Let's now apply this theory to an example. If the auditor had identified there is a risk that sales are fictitious, that is, sales are not real and falsified to increase revenue, what would be the assertion at risk here? As the risk is associated with sales, which is a profit and loss statement item, the category of assertions would be the class of transactions assertions. And the assertion most at risk would be occurrence, which links directly to the risk that's been identified in this instance. Would your answer be different if the risk was debtors' balances are not real or bona fide? Now here, the risk is associated with the debtors or accounts receivable account, which is a balance sheet account. So the category of assertions would be the account balance assertions. And the assertion most at risk would be existence, and this directly links to the risk identified. Notice that there are many of the assertions have a similar meaning between each other. This was also seen in the example we just went through. The difference is ensuring you select the correct category of assertions based on whether it's an item in the profit and loss statement or in the balance sheet. A final point to make while we're on the topic of assertions is although the auditor needs to obtain audit evidence in relation to all assertions that are applicable to each class of transaction, account, and disclosure, having specific knowledge of the assertions that are at the greatest risk of material misstatement helps the auditor to direct the audit effort to what is most needed. So as management will typically want to show the best results for the entity, this may lead to management to adopt policies, procedures, and accounting practices that promote an overstatement of assets or an understatement of liabilities to improve the net asset position, or an overstatement of revenues or an understatement of expenses to increase the entity's reported profit. As a result, auditors usually assume there is a greater risk of material misstatement in relation to the following: the occurrence, accuracy, and cutoff of revenues, the existence, accuracy, valuation, allocation, and rights and obligations of assets, the completeness and accuracy, valuation, allocation of liabilities, and the completeness, accuracy, and cutoff of expenses. The auditor may classify certain risks as significant risks. These risks, which include fraud risks, require special audit consideration by the auditor under ISA 315 revised. Therefore, these items require more audit time and effort than other items in the financial statements. As illustrated in this diagram, significant risks are those risks of material misstatement that have both a high likelihood of occurrence and a high magnitude of impact on the financial statements. Significant risks are assessed based on their inherent risks and are assessed before considering any related mitigating controls implemented by management. This means that these risks are inherently significant because of their nature and not because of the absence of internal controls. The following factors need to be considered when assessing which risks are significant: whether there is a risk of fraud, whether the risk is related to recent significant economic, accounting, or other developments that require specific attention, the complexity of transactions, whether the risk involves significant transactions with related parties. As related parties are not independent of each other and often involve having control or significant influence over each other, related party transactions often present a higher risk of material misstatement due to fraud than transactions with unrelated parties. So as part of the risk assessment of related party relationships and transactions, the auditor performs specific inquiries of management as required by ISA 550. Another factor to consider when assessing which risks are significant is the degree of subjectivity in the measurement of financial information that is related to the risk. This would also include risks relating to accounting estimates, which need to be considered as part of the risk assessment process in accordance with ISA 540, which is covered in more detail in this unit. Last but not least, a risk may be significant if the risk involves a significant transaction outside the entity's normal course of business. All of these 6 factors are outlined in ISA 315 revised. Note that the risk of fraud is considered so significant that a specific auditing standard, ISA 240, exists to give auditors further requirements and guidance. In summary, ISA 240 explains that fraud involves incentive or pressure to commit fraud, a perceived opportunity to do so, and some rationalisation for committing the fraud. Collectively, these factors are commonly referred to as the fraud triangle, because when all 3 are present, it is highly likely that fraud is occurring. There are 2 types of fraud relevant to the auditor: fraudulent financial reporting, which involves manipulation of the financial statements, and misappropriation of assets. A common example would be stealing. Note that ISA 240 requires the auditor to presume that there is a risk of fraud in revenue recognition. That sums up our overview of Unit 3. If you have any further questions regarding Unit 3, please post them on the discussion board. Thank you for watching this video. Look out for other overview videos for other units in the AAA module. We wish you all the very best of luck in your studies.